Good afternoon. It's now just past midday in the UK, and therefore it's time to begin our webinar on Pacific assets, where we detail how the trust is managed in Asia's volatile year. I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and I'm pleased to be joined by one of the managers of PAC, Doug Ledingham. In this presentation, which is being recorded on the day of the annual results, Doug will spend around 30 or so minutes talking through the recent performance of the trust, how it is positioned, and what factors have influenced these. After the presentation, we'll have around 15 minutes of Q&A where you can ask questions using the function in WebEx below. For the best experience of using WebEx and including seeing the slides, we would advise the audience to download the WebEx app. And for those who miss anything in the presentation, there will be a recording available on our website later on and a place to download the slides as PDF. Now, without any further ado, I'd like to hand over to Doug for his presentation.
Thank you very much, Ryan. As Ryan mentioned, we recently announced the financial results of Pacific Assets. So I thought perhaps it's best to touch on those, even though they are for the 12 months ending the 31st of January. So yeah, Pacific Assets NAV increased 9.7% versus a return of 22% for the benchmark. Over the longer time frame, over 5 years, which is really the time frame and beyond that we're looking to deliver value to shareholders, the trust generated return of 52% versus the benchmark of 27%. We as share investors and the way that we manage Pacific Assets, we are looking to deliver the most attractive long-term returns to shareholders, and we do that through the constant application of a philosophy that we've utilized since 1988. One that sees risk as the risk of losing your money rather than deviation from a benchmark. And with that view of risk, we're free to think differently than many of our peers. And in doing so, we aim to take a longer term time horizon. At point of investment, we're looking out 10 years. And that's really, as an investment team, that's what we're passionate about. That's what our philosophy focuses on. And that's what the structure of our organization is built to support. So, if you look over the period over which Share Investors has managed Pacific Assets, we have managed to outperform the index over every rolling 10-year period and the vast majority of every rolling 5-year period. And I think if you're to look back over the long-term compounding of NAV over that period, that I think there's been it's an important reflection on the need and ability for fund managers to think and act differently to the index. Only by ignoring the index, I think that we can look to deliver outsized returns. I'll jump to this is the returns to the end of March. Ryan touched on at the beginning how have we performed in a volatile year for Asian equities, and if you look at that 12-month period, I mean, we're unsatisfied with those returns. They are largely driven by the short-term underperformance of some of our Indian holdings. And if you were to go back 12 months ago, there really was a period by which the Chinese equities were going through significant pain. That has reversed somewhat, and you've seen that reflected in the NAV performance of the trust versus the benchmark. I can say that there's been no shift in the investment philosophy. It seems it's the same philosophy, the same team that's managing the fund. What I would highlight is that we are not trying to optimize the performance of the fund over every rolling 12-month period, and I would always push emphasis out to those longer term time periods, whether it be 5, 7, 10 years or beyond. And as I mentioned, that's really where we believe our philosophy can offer significant value. By focusing on very much who we're handing your money to, looking for highly trusted, competent individuals that have their own money invested alongside us as shareholders, operating in attractive markets, managing unique franchises, and by owning those companies for the long term, that's really what we're looking for in terms of delivering attractive, capital preservation and growth to you, the shareholders of the trust. We're not, I think by emphasizing that, every philosophy needs to have a trade-off, and for us, that trade-off is we're willing to forego that the short-term 12-month period performance in a desire to, as I mentioned, consistently offer that longer term offering. And I think if you again look down at those discrete 12-month periods or calendar year performance at the bottom of that chart, you can really see, I hope anyway, over time, that where the value of the trust comes to the fore. When you do see significant drawdowns in the market, that our companies tend to hold up far better because of the resilience of their balance sheets, because of their ability to control prices, and because of the resilience of the value proposition that they're offering their customers, that they have in the past tended to hold up far better, and in times of stress are able to control their, they've got far more control of their own destiny. And we've seen again, time and time again, whether that's the Asian financial crisis, the GFC, COVID, the types of companies that we're handing the trust capital to, again, those individuals that can think independently because they've got great balance sheets, and because they are material owners in the firm, can maintain that long-term time horizon in regards to how they're investing both in capital and people. And you have seen, whether again at these depths of market lows, our companies holding on to their employees, investing counter-cyclically, and coming out of these down markets, really coming out in a far stronger position. And we can touch on tariffs in the world that we live in today, throughout the course of this presentation and in Q&A. But I would really highlight that during these periods of extreme uncertainty, that those companies that are managed by individuals and groups of individuals who have all of their capital invested in this business, and who are looking to build a business that can endure and survive and prosper over the next 10 years rather than the 10 months. That's really where you want to have your capital in these periods of extreme uncertainty. We are not the managers that are going to be trying to decipher Trump's tweets and express that in portfolio transactions on a daily or monthly basis. What we're trying to do in periods such as this, with daily news flow that's quite extreme in nature, is to step back as much as possible from stock prices, and get out on the road and meet companies, get on the phone and talk to people, and just remind ourselves of the caliber and the time horizon of the people that we're entrusting the Pacific Assets Trust capital to. And that we can, again, important to remove ourselves from that short-term noise and ground ourselves in the reality of who's managing these businesses and why they're choosing to manage them in such a way. I've got a couple of graphs here that visualizes the evolution of the trust over time, and again, hopefully in each of these we can reflect on some interesting evolutions or changes in the trust over time. So this goes back to 2010, where Stewart Investors first had the privilege of managing the trust. And I think what's important for us is to look at the China and Hong Kong exposure first and foremost. So when we first took over the trust in 2010, that Hong Kong and China exposure was more than 20%. We were invested in largely Hong Kong-based companies, but these Hong Kong-based companies having a significant revenue share coming from the mainland. Today, we are creeping back towards that exposure. So we've got roughly, I think, 17% invested in China at the moment. We're very keen to emphasize that the greater weighting in China is not a change in our philosophy. It's not a change in the personnel managing the trust. It is a function of where we see bottom up the best opportunities to invest the trust capital. For the course of the last 10 years, you can see there's been relatively limited exposure to Hong Kong and China. And that has been a reflection of bottom up, the opportunity set that we have in front of us. The Hong Kong-based companies that Stewart Investors have invested in, for a long period of time, whether it be in the land companies, whether it be in companies building required infrastructure for natural gas and for an industrial or residential setting, these are the companies we're owning in 2010. the proposition for us as long-term holders has changed, and you therefore don't see them in the portfolio anymore. Over the last 10 years, the kind of companies that we get excited about, that are listed in mainland China, the companies that we can find, long-term owners who operate independently, managing unique franchises that have attractive levels of growth that should benefit from, where the CCP wants to take the Chinese economy. Lots of these companies hadn't been listed for very long. For us, financial history is an important guide for us as we build conviction in the quality of the people and the franchise. We love to see and have as much history as possible in regard to how a franchise, say, has evolved or operated in times of extreme stress, and the decisions and behaviors of the people at the top. And just for many companies in China, the types of companies we get excited about, the financial history just hadn't been available to us. So every incremental year that goes past, we've got more evidence to weight in our decisions on trust and competency, and that has led to a greater exposure to China over time. What else has changed is valuations. Again, if we're to look back over the last kind of 5-10 years, the Chinese index itself has always looked very, very cheap versus other indexes globally. That has been a function of the makeup of the index, and the fact that there has been a significant presence in that index from state-owned enterprises, whether that be in financial services, whether it be oil and gas, and I suppose more recently in the technology space. We are very comfortable and very privileged to be able to develop the portfolio completely bottom up, and position size as being a function of where we see the greatest opportunities for capital preservation and growth, and that being a function of conviction and quality and valuations. And we'd never feel any pressure to own a particular company, sector, or country based on their index weight. It's very much a function of those bottom-up factors. And as I said, in the last 12-18 months, we have seen valuations for the types of companies that we get excited about become more attractive and offer a far safer return, and that you're not crossing your fingers and hoping for valuations to be very attractive in 10 years' time. That for us as long-term owners, we can, in our view, deliver very attractive returns as owners of the business, and the underlying share price growth being driven by growth in earnings. And we see that that's present across the technology space and industrials, and that's really why you've seen the increase in the trust exposure to China over time. There hasn't been any, like I said, any shift in philosophy. We are still coming back to the trade-offs and the biases that any philosophy has. I think if you are consistent in a philosophy and you're passionate believers in it, you should be able to point to the biases of or the outcomes of a certain selected inputs. And for us, we are always biased towards sectors and countries where there is a deep vein of wonderful people that have their own capital on the line, that think about us as minorities, and who have the competence to not only create value over the long term through their franchise, but also choose to share it with minorities. And those biases continue to reflect themselves in the country allocation, that we continue to have a material weight in India. That is not a function of our view of Modi. It's not a function of our top-down view of macroeconomics or particular themes. It's where today do we get most excited about the ability of these companies to create value for Pacific Asset shareholders. And India for us is just such a rich opportunity set. It's a very deep and broad equity market, which provides us significant opportunity to own great companies across multiple sectors, rather than perhaps in some countries in emerging markets where you're forced to either have a view on a financial or a telecom or a brewery. The depths of the Indian equity market is just very exciting for us as bottom-up long-term stock pickers, and we don't see any material change in that Indian weighting. There has, we have trimmed that exposure over the last 12 months. There has been particular parts of that market that have re-rated to levels by which we think the capital's at risk. But underlying all of that, the quality hasn't changed. There's a large, deep equity market with revenues generated by a large domestically focused economy with a number of very attractive tailwinds that there's some exposure to tariffs and the like, but really it's for us it's a largely a safe place from a cash flow perspective in our view over the next kind of 5 and 10 years. Jumping to the sector exposure, that's probably a better reflection of where you've seen some changes and where we've seen perhaps valuations become too lofty for our liking, and that's really seen in the consumer staple space. For a very long time, consumer staples in India was a very simple decision on our part. You were not being asked to pay extreme valuations for a wonderful ownership, brands that had very strong and resilient pricing power. You had earnings that were benefiting from very robust tailwinds as consumer companies benefited not only from a rise of the middle class, but also greater market share from the unorganized segments. And as we all know, with consumer staples, at the depths of market lows, people still need to brush their teeth. They still need to wash their hair. That resilience of cash flows is very much what we desire at Stewart Investors. But for us, sadly, two reasons really why we've chosen to trim our exposure to consumer staples. The major point is valuations, and that if we are forced to pay too high a valuation for growth, we don't believe that it provides the resilience and defensiveness that we seek in those cash flows. Perhaps 10 years ago, we were able to pay 20 times earnings for very attractive earnings growth. In India today, you see some consumer staples names are 80 or 90 priced to 80 or 90 times earnings, which I think is a function of people looking for safety. But for us, the more people that crowd into a particular sector based on safety, probably the less safe it is as a long-term owner. So yeah, we have chosen to trim that exposure. Now, if you to look over the very short term, that has been the wrong thing to do in India, as I think top-down people have been concerned about macroeconomic stress. So the answer has been to rush into consumer staples, and they are actually one of the best performing sectors in India over the last 3 months. But like I said, what you've seen there is multiples increased to even more extreme lofty levels. These companies continue to stay on our watch list, but really we'll be looking for far more attractive valuations before we commit any more capital to these names. The rise of industrials, I just quickly, you probably want to touch on that. I think that's another fabulous example of why it's so exciting to be an allocator of capital and an investor in Asia, is this the dynamism of these markets. So when we first took over management of the trust in 2010, there just wasn't that many high quality industrials for us to invest in. There were, if they were very small. Now today, especially in China and India, we are seeing the emergence of some truly exceptional industrial companies. Whether that be in India, where you've got industrial companies that are looking to not only dominate the large domestic market and benefit from a growth in capex and a growth in India's desire to be a global manufacturing hub, they're globally aspirational in their targets for the next 10 years. In not only their growth, but they want to take on US and European industrials from a quality perspective. And for us, that's just a very, very exciting proposition. And that's why you see more material weight in industrials and in Pacific assets, is that we are investing the trust's capital alongside very passionate, aspirational owners of industrial businesses that are investing today in improving quality, improving the value proposition. So for the next 10 years, it's largely a function of taking market share from global players outside of India. In China, we have a really exciting group of industrial names that are replicating business models that we've seen create significant value for shareholders in other markets. And not only is that exciting in an absolute sense in terms of the value proposition that they're offering their customers, where in the broadest sense, our industrial companies are helping their customers to become more efficient, more productive, and spend more time on their your core offering, that's a very attractive proposition and counter-cyclical proposition in times of stress. And again, we've seen this in Europe and the US, where really world-class industrial companies come out of periods of economic stress far stronger than they went in. Because if, as a manufacturing company, I'm going through a slowdown in my sales growth, how do I protect bottom line? Perhaps I've become too lazy in the good times, and I want to become more efficient and productive. Then I look to use the services provided by Yeheda or AirTac, or the companies that we're owning in the portfolio. And we are excited about that value proposition, but also excited about these companies taking market share from global players within China. That has been a tailwind for many companies over the last 5 years, certainly since Trump 1.0. But I certainly see that the tailwind behind high quality industrial companies in China taking market share from multinationals is a strong one, and I think a very exciting and attractive place for us to be. One of our names, Shenzhen Innovents, which is a leading company in robotics and automation, it reported today sales growth of over 30% year on year, with continued aspirations of between 10 and 30% year on year growth. And that's what we're looking for when allocating the trust capital and your savings to China. Aspirational entrepreneurial management teams who are able to generate growth and create value as much as possible independently from the macroeconomic environment. So I think both this sector evolution over time, the country evolution over time, it does reflect hopefully a consistency in philosophy. What I would highlight in both this and the country allocation is that you've not seen any major spikes in turnover or evolution of the portfolio in particular, I'd say high stress environments. So you didn't see, or you can't see here, material change in the portfolio during India's multiple financial crises over the last 10 years. There was no material change after Modi came in. There's no material change after Modi's re-election. We didn't materially change the portfolio during COVID, or where there was a major shift in interest rates rhetoric and regime post kind of COVID easy money. We are looking to build a portfolio that's robust and resilient to most macroeconomic environments, in the view that it's very difficult to guess what's going to happen short term, and even harder to try and guess what's going to happen to short term share prices based on that news. So I really hope that this visualization both of sector and country reflects a consistency of philosophy, and as I said, evidences the passion that we have and the biases that we have for particular markets and particular countries. What I wanted to highlight here is that, again, when we're allocating your capital to India and China, we are not owning the benchmarks in either situation. So we will own companies that behave, well, first of all, look and behave very differently to the benchmark. In India, you see that despite us having a material weight there, we are not owning the largest, the vast majority of the largest companies in India. That's a function of many companies not meeting our desire for quality of franchise. They might be, utility companies or involved in construction, which for us are very fragile to macroeconomic shifts and more importantly shifts in political power. We want companies that have survived and prospered and have the ability to do so, during most macroeconomic environments, and especially independent of who's in political power. Outside of franchises that we get uncomfortable with, there are a large number of family-owned companies within India that we would not hand your money to. I think perhaps there's maybe some belief that because we are so passionate and we get so excited about finding long-term owners, that we kind of close our eyes after we find great term owners. What we find after finding a long-term owner, we want very, very high-performing owners. So we reject the vast majority of families that we come across. We're looking for those unique owners that have, first of all, the capacity to think long term, capacity to think independently, but also from a family perspective, you have that humility to realize that they're not perhaps not the right people to be managing the business longer term, and have that ability to bring in professional CEOs. So, I could go on for hours about the many stories and examples of how families destroy capital, either in the short term or over the long term. But really, we are looking for all the ways that we could lose your money and reject them very quickly, and what we're left with is a particular subset of owners and thinkers. Again, on the China side, yes, we've increased our exposure, but we are not owning the China A-share index. Again, that's a reflection of the number of explicitly state-owned and implicitly state-controlled companies that operate in the A-share market, that we find it very difficult to hand your hard-earned savings to. And again, in China, there's a lot of markets where or sectors where the players are very much focused on being the largest rather than the best, which is a very dangerous position to be in, and that there might be a large addressable market with lots of growth. But if you have operators that have no care or desire for first of all, creating profits through through a unique business model, and then second of all, who have an inability to share those profits because they have constantly got to be reinvested in capital and repaying debt. For us, that's just where we find it very struggle to invest your savings. So when we are investing in China, it's a small subset of companies where they have the ownership characteristics that we get excited about. They have unique franchises that have the ability to create value. They've got great balance sheets, and they are, in our view, very well aligned for where China needs to develop over the next 10, 15 years, whether that's higher end manufacturing or the creation of high quality industrials. That's where you find your money invested. It's not in Chinese state-owned banks or the like. Again, very quickly, that this, perhaps those of you who've heard from me in the past have seen this, but it's a slicing of the portfolio, not by country or sector, but again, who we're handing your money to. Again, hopefully you see that our philosophy and the biases that come from wanting to find great people to hand your money to is reflected in significant family owners, significant weight in founder-led companies. Free float, that's a category where there's an open shareholder register, and there is no long-term owner. Where we are handing your capital to these companies, we're really looking for evidence that there is a founder mindset. There's a mindset and culture of putting customers first, of building a long-term enterprise, rather than a company that's willing to and desires to pander to the short-term investment community or maximize shareholder value over the short term at the expense of the long term. So yeah, hopefully again this is an important outcome of the inputs that we get so excited about. Very quickly, is this I do enjoy this slide, especially on the right hand side, because it evidences what we experience every day when talking to companies, and that it's very, very difficult and increasingly challenging for managers of companies listed on the stock market to take a divergent view and to resist the temptations and the pressures of short-termism. Everybody wants answers today. Everybody wants the deliver of short-term earnings on an ever accelerating treadmill, and that really comes at the expense of short-term value, of long-term value creation. And here this is a function of this data on the right hand side. That's the result of a survey, and some data points on just the challenges that CFOs feels, and then also that data on the shortening tenure of corporate executives. For us, it's a very simple proposition. Would we rather have specific assets shareholders invested alongside mercenary professional CEOs who are only going to stick around for a few years and have the potential to make tens of millions of dollars? They will make a particular set of decisions because of their time horizons, because of their incentives, or do we want to own their peer where they have control of the time horizons, they're investing for 10 years rather than 10 months. And that's really reflected in how they choose to build the culture, how they choose to build the balance sheet, how they choose to diversify the supply chain in a time of, increasing uncertainty. I think in the investment community, again, volatility is highlighted as risk, but, for us, risk is handing, your money to misaligned owners of businesses. I'll finish quickly on what the portfolio looks like today. As I mentioned, India continues to be the major allocation in terms of countries that we have. That's unlikely to change very quickly, as I mentioned, because of the depth of opportunities that we find in that market, and the breadth of opportunities, probably more importantly, rather than it being the trust being exposed to a single sector or theme in India. We are able to have a very diversified set of, in our view, very high quality cash flows that provides the resilience that we're looking for. China, we've got two names there in the top 10, both of which we believe to be very attractively valued, with great balance sheets and really reflect all the inputs that I've spoken about for the last half an hour. What I would reflect on is we have increased the weight of Pacific assets to the Philippines over the last 12 months. We, as bottom-up stock pickers, are always looking for sectors or countries where there's particular clouds hanging over them, which may create opportunities for investors that can think differently and take a slightly different perspective on things. And the Philippines certainly feels an example of that today. It does feel like a market that's the kind of foreign investor has long forgotten, with foreign ownership levels, I think, back towards record lows. We've got valuations close to the lows that we saw in the financial crisis, or the Great Financial Crisis, or the Asian financial crisis. And importantly, bottom up, companies that are very focused on generating improved earnings quality. So Ayala Corporation is one of the larger holdings. We're owning that because not only from a valuation perspective, and that we think it's you're very cheaply valued from most angles, but the change that's going on in that organization. So Ayala is an 8th generation family-owned Filipino company. They, for the first time, have just appointed their first professional CEO. Now they've been given a mandate to really reassess the quality of that portfolio, sell off underperforming assets, and reinvest in areas where they believe there's an opportunity for higher quality growth. So for us, we were in the Philippines 3 weeks ago, meeting a number of companies, the vast majority of which are very focused on shareholder returns, are very focused on improving asset quality and earnings quality, and it just feels a very attractive opportunity for us to be allocating more of the trust capital to these companies at very low valuations. From a valuation perspective, this is probably the cheapest that the trust has been from a free cash flow yield perspective, relative to the index in absolute terms, in probably the last 10 years. That is a very exciting proposition for us longer term, and that not only do we believe that the owners and managers of the companies that the trust capital are invested in are far higher quality than those that sit towards the top of the index. Our companies have better balance sheets. They have higher returns on capital, and I believe that they will grow faster than the index over the next 5 and 10 years. So where we are today, yes, there's lots of volatility and lots of short-term noise, but we have some fantastic companies run by great people on very attractive valuations in a region where there's probably some of the highest return opportunities over the next 10 years, whether that be from some of the fastest growing evolving profit pools, but some of the most intractable problems that we have founders looking to solve. And we are always perennially long-term positive, but short-term nervous. And I think that probably is fair reflection of where we are today, and that lots of noise. But when we step back and look at the the companies that we're owning and the quality of the balance sheets and those valuations, that we do believe that Pacific Assets remains a very attractive long-term allocation to the region. So yeah, thank you very much for your time, especially on a glorious day like today.
Thank you very much, Doug. That was very interesting. We've had quite a few questions come in, though I would remind everybody that we still have around 10, potentially 15 minutes of Q&A, so please do keep them firing in using the box in the WebEx app. I'll actually start with the Philippines, if I may. It's got talked about it near the end, a bit of a standout allocation. There are a couple of other countries in the region as well that have proved quite popular amongst your peers. One of them being Vietnam, which has produced a lot of excitement, and the other is Indonesia, which is also trading at very attractive valuations. What are your thoughts on those two countries, please?
So Vietnam has been, I can really admit it, it's been a mistake that we haven't had the trust capital invested there. There's been 2 or 3 companies that really hit the mark on the characteristics that we're looking for. So FPT, which is IT services and telecoms, and Mobile World, which is a retailer. Both of those companies really reflecting the endurance, the adaptability, the long-term time horizon that we're looking for. We got too focused on valuations, and can only apologize that we've not invested there, because we have missed out on attractive returns. What I can say is that reflecting on Vietnam, so we've made the mistake as portfolio managers not having more invested in there. The companies that we own in the trust, Vietnam has been probably the place where they've chosen to diversify their supply chains to post-Trump 1.0. It's a home to cheap labor force, with the infrastructure and the foundation to build a high quality manufacturing base. I think we were surprised, and I'm sure the allocators that we're investing alongside were very surprised when Vietnam appeared at the top of Trump's magnificently colored board. You have seen some of our companies experience some short-term share price pain because of the exposure that these companies have to Vietnam. But I think that only speaks to, if you have been an operator of a company in Asia over the last 5 years, all your capital is invested alongside, or all your capital is invested in this business. What will you do to increase the survivability, increase the resilience and adaptability of your business? It has been to diversify away from China and into India and Vietnam, and that decision to invest in Vietnam has been punished. How that works itself out for the next few months, we're not sure, but certainly the companies that we're owning are immensely adaptive, both in the supply chain perspective, but in regard to the customer proposition that they're offering, it is unique and valued, and we do believe that they have the ability to pass on any price increases and evolve alongside customer demands. But yeah, Vietnam, we're reassessing a couple of companies at the moment, but again, I can only apologize for not having the trust capital invested there over the last 10 years. Indonesia, it's a wonderful place to look for opportunities in a closed-ended vehicle, because I think for us the majority of the opportunities sit in that small mid-cap space, where liquidity is not as deep as the larger cap names, and therefore is not quite as attractive for an open-ended vehicle. Whereas with Pacific Assets and its closed-ended nature, we do have a greater exposure to Indonesia here than we do in our other open-ended vehicles. So as the question alluded to, it is a market that is throwing up some very attractive valuations at the moment for companies that are very profitable, and in our view, very well positioned for long-term growth. So we have a couple of members of the team going out to Indonesia in the next couple of weeks to get there, out on the ground and talk to companies. And again, I would be very surprised if you didn't see Indonesia increase over time, just given that opportunity set from a valuation perspective, and the types of companies that are available to us in that kind of small mid-cap space. So thank you for that question.
Interesting, thank you. We've had a question in on performance, and I know You, in the results piece that we've just written, that you have sort of delivered absolute positive absolute returns in 8 of the past 9 years, but 2025 is off to quite a difficult start. You've
Yep.
got sort of negative return that first quarter.
Yep.
Can you just talk us through what's happened there, what's impacted the trust?
Yeah, no, thank you very much. So I think I'd say two contributing factors. The first would be that divergence in performance between China and India. So you've seen, our types of companies have something of a headwind. Chinese index doing very well, and then you then had Liberation Day, which then brought all markets down together, and has punished particular sectors more than others. So an interesting combination of pressures. If you look at the Indian market, I think it's now flat year to date. Our companies, I think, probably would have underperformed that. That has been the result of the Indian market being dominated by, well, large chunks of financials. So ICICI Bank, which is a company that we don't own, is a large holding, as is Kotak Mahindra Bank, is a large position index. We don't own those. They've done well. As I mentioned, the consumer staples sectors have sector has done well based on that. I think reach for defensiveness. We've got a lower exposure to those names, and because of the concentration of our Indian holdings, the divergence in performance would be largely stock specific on our part. Cube Investments, which is one of the larger holdings, is an industrial name that's come under a bit of pressure year to date. I think largely as a function of concern about what tariffs mean for the industrial space in India, and a slight cooling off in valuations. You've also seen that in Mahindra, which is a conglomerate with multiple revenue streams. Again, I think it's been sold off on macroeconomic concerns. The majority of Mahindra's earnings come from tractors, where they've had the leading market share in tractors for 4 decades. The Indian agricultural cycle, which is still has a major influence on Indian economic growth, I would say it's been in the doldrums, but it's been pretty lackluster over the last 3-4 years. There have been signs of an uptick in that cycle, and where Indian interest rates are at the moment, you have that ability for interest rates to come down, which will benefit the consumption of farmers and the purchase of tractors. So, for us, we're owning Mahindra for its diversified cash flow stream, and I think probably the Indian agricultural cycle is as far away from Trump's tweets as you can find. So again, we've not really seen us touch that position outside of perhaps not wanting the portfolio to be overly exposed to a few names. And then finally in India, the Indian IT service companies have come under pressure again. This tends to happen where there's questions over US economic growth or European economic growth. Despite being listed in India, Tata Consultancy Services or Tech Mahindra, the companies that we own, the vast majority of their earnings come from overseas, whether it be the US or Europe. And they are, in our view, they've evolved from being pure low-cost outsourcers to being vital partners for their customers that are evolving their business models to the 21st century. So very much kind of utility technology companies, but if you see the volatility of their share prices, they do move quite considerably on those top-down concerns. For us, they're remarkably resilient and adaptive businesses, and you've seen the share prices move far more than any revision of earnings or cash flow. So IT services, the exposure to industrials versus consumer staples and financials have certainly impacted the divergent performance in the trust over the very short term.
Okay, thank you for that. And I'm conscious that we have 1 minute of the formal time slot remaining, and I'm probably keeping everybody away from the sunshine. So we'll just do one more question if we can. Because of your approach of that very long-term time horizon and investing alongside sort of family ownerships and things like that, do you think that the strategy is sort of akin to a private equity approach?
I think we could probably go down a very interesting rabbit hole of talking about private equity approaches, because I'd argue that the vast majority of private equity owners that you come across are maximizing the business for an exit, whether that be 3 or 5 years, and that feeds into a particular set of behaviors and a particular set of outcomes. And given the prevalence of private equity today, I think either people listening or somebody they know will work for a company that is owned by private equity, and I'm sure they've got very lucid examples of how things change under, I'd say most private equity ownerships. There are unique private equity enterprises that really are taking that long-term view, but yeah, I'd say that we're looking for businesses that have the ability to have a time horizon beyond private equity, and are building businesses that are or have behaviors and outcomes that reflect that time horizon. Now, I think how we operate, we are trying to learn as much as possible from these businesses and much as possible from those investors and corporates globally who have been able to take a long-term time horizon and apply that to their advantage. That's what we're trying to do, day to day, but understanding that we do, our companies are marked to market every day, which creates far more volatility and therefore behavioral challenges versus it must be lovely to be a private equity manager and not have to have your prices marked to market every day and you can kind of make them up. So for us, I think we're trying to manage it with that long-term time horizon, while also having the greater challenge of managing through volatility. And I think for us, hopefully you're seeing in terms of outcomes of the people that we're handing your money to, the relatively low turnover of the trust, that we are continually trying to manage that with that long-term time horizon, and not be whipped around with noise, whipped around with short-term returns, and remaining constantly focused on trying to maintain that long-term track record of specific assets and manage it to our target and our desire of being where owners of capital and want to come with their savings if they want a long-term allocation to Asia.
Yeah, well, what a great note to finish on there, Doug. Thank you very much for your time, and to all of our listeners for tuning in and for the questions as well.
And thank you very much, Ryan. And again, thank you all for choosing to listen to me rather than being outside in the sun. So thank you very much.
Thank you. If you would like to find out more about the trust, please visit its profile on the KTI website, where you can also see our analysis piece on the results that were released this morning. Just leaves me to say, enjoy the rest of your day. The presentation will be available later on, if not tomorrow, and please enjoy the weather. Goodbye.
Thank you. Bye.